Welcome back to the Williams Real Estate Channel. Today we are discussing the macro market update for November 2025. So we've had a few things coming to light throughout the month, which are quite interesting as we enter the final stages of the land boom and the winner's curse phase of the 18-year land cycle. And now I would say equivalent point of time would be around late 2006, early 2007 in the prior cycle. As we come into the market top in 2026 will be peak land market, and come 27 peak stock markets. But come 2028, that's when the mainstream herd will finally see that we have entered the next land-driven downturn. They'll call it something, I'm sure, but we're due. We're due. We're coming into the final quarter where we're seeing the likes of Darwin, regional South Australia, regional WA, regional Queensland outperform. But when the market turns, the markets from Brisbane, Perth, Adelaide, Darwin, South Australia, WA will enter their downturns, and then the ripple effect will come back to Sydney and Melbourne, just like what happened from around 2008. Sydney and Melbourne will then be away at the races again, getting all the demand in the future years ahead, as they haven't had a solid run in recent years. Hence the reason why we are sowing our seeds across these markets over the last 2 years to date in preparation for the coming bull run. So this is our framework, and the purpose of today is to provide a bit more clarity of how I see us being on this blue marker in time and heading into the final stages of the cycle where we're due for the next land-driven downturn. First is the Australian GDP growth rate. There hasn't been any further data as of June 2025, but we're keeping a close watch on this as it evolves. The Australian unemployment rate has picked up, trended up to 4.4%, as 3,100 people have lost their jobs, as unemployment has risen to 669,600 people across Australia, and youth unemployment rate is sitting at 9.8%. So unemployment has started to trend up off its base in 2022, and to date he's up to 4.4%. So still low in historical averages. However, if you look back at long-term historical trends, once it starts to trend up, it continues to run. And I can only see this continue to accelerate as we come into the final market top in 26, 27, then come 28, will probably run very high, just like what happened in the COVID mid-cycle slowdown, as well as the GFC in 2008, 91, in the early 90s. So we're due, and we're keeping a close eye on this, along with the Australian inflation rate has picked up to 3.8%, has been trending up since June 2025, and as of the latest data in October, it's up to 3.8%. That's the all goods inflation up to 3.8, and the trim mean is sitting at 3.3, which is what the RBA also keeps a close eye on. But the inflation rate takes precedent over the unemployment rate. So this now being well above their target range, you cannot expect a rate cut in the coming months, even years. And the main contributor has been electricity, which has been up 37.1% in the last 12 months. So the Reserve Bank held the cash rate at 3.6% in November, and their next meeting is on the 9th of December next week. But I would be sure that they are definitely not cutting, and they'll probably hold. If not, I see chances are that rates could even start to trend up again as they're keeping a close watch on inflation. Interesting fact is I recently refinanced my whole portfolio to Bank West at 5.5%, and I only just settled today. My mortgage broker called me and saying we just snuck in to settling at 5.5% because I fixed the rate for 2 years as I see rates going up from here. And he called me this morning to confirm that the rates have all been fixed as the loans have settled, and we just snuck in as Bank West, along with a number of other banks, are starting to increase their fixed rates. So they can see it coming. They can see the writing on the wall that rates will probably go up from where they are today, which ultimately will end the cycle. History shows in the later stages, pre-GFC, so in 2006-7, in the late 80s, 88, 89, and in the late 60s before the 72 downturn. In the final year or two of the cycle, rates have always gone up. So I see rates going up from here, just like what happened pre-GFC, continues to go up. And then once 2028 comes around and the land-driven downturn starts to set in, the RBA will then panic again and drop rates pretty aggressively, just like what they did in 2009-10 and as well as in 2020. So history shows that rates will probably end up going up from here to ultimately end the cycle. We're keeping a close eye on the US as the US leads the land market. There hasn't been any further data as of Q2 2025 for the GDP growth rate. I will keep a close eye on this for as the data continues to evolve. Same goes for the unemployment rate. No further data as of September. Its last recorded was at 4.4% and similar to Australia has started to trend up. So we'll keep a close eye on that also, as well as the inflation rate. No further data this month, but has been continually trending up since April this year and is sitting at 3%, well above the US target of 2%. As of October, there hasn't been any movements, and it will be interesting to see what happens over the coming months as Jerome Powell, the federal chair, sees his last couple of months in his position as Trump is lining up a replacement for someone that will be lenient to drop rates. So it'll be fascinating to see what happens in the US come early next year and over 2026. And if they actually drop rates as what Trump is wanting them to do. He's a property guy. He wants low rates. He wants better cash flows and he wants higher valuations on his properties. But it's not in the best interest of the country or the economy to drop rates when inflation is starting to get away, because ultimately inflation will then run very high. That will ultimately mean rates will have to go up higher in order to suppress inflation back down again. So time will tell, see what happens in the States, but it's a leading indicator for us in Australia, as historically the US leads and Australia trails 6 to 12 months behind the US markets. Interesting to see recently this month, APRA has stepped in to clamp down on credit, starting its credit squeeze. They are concerned around the rising level of housing credit, increasing now with lower rates and first home buyer grants. So APRA has written to all the banks requiring them as of Feb 2026 to limit their residential home mortgage lending to people who are taking on more than 6 times their income. to only 20% of their new book value. So for all the smaller lenders, because typically the big banks don't lend more than 5 times income. So all the smaller second tier lenders who do lend more than 6 times, they're now being told that they can only lend 20% of all new loans to people who are taking on more than 6 times their income. So that will restrict lending a bit. But as you can see, the percentage is around 7 to 8% of all new loans currently being going to people that are taking on loans more than 6 times their income. APRA is obviously looking to avoid a similar credit boom that we saw out of COVID from 2021, 22, where there was cheap money, low rates, lots of people taking on big loans and putting that into the market. That's why we saw that boom. And that's obviously been squeezed back now. We're even seeing it on the ground in certain asset classes in farmland, had high valuations throughout 21 and 2022 and are now selling at 30 to 40% discount than previously. That's all driven by credit. So it's early days for APRA. They have noted in the statement to the banks that they'll also look at further restrictions on investors if the risks to lending continues to materialize as this current cycle plays out. And if we look back at history and see what happened the last time APRA stepped in was back in 2018, 2019. So this could be on the horizon. And if you overlay what's happening towards the tail end of the cycle where we're due for the land-driven downturn, if you overlay it, this now coming into play, APRA, you can see how it can head towards the end of cycle, especially in the markets that have had a solid run in recent years, such as Brisbane, Perth, Adelaide, Darwin, and their respective regions. So be sure to be getting in the right markets if you're looking to buy, getting into the markets that haven't had huge amounts of growth in recent years as they're coming off a lower base. As when you buy towards the tail end of a stagnant flat period, the downside risk is minimal and it's only upside opportunity, just a matter of when the market starts to move on again. So the markets that have been booming in recent years, I see them definitely at high risk. Stock markets continue to rally and trending at all-time highs. Classic euphoria we see towards the tail end of the boom until the supposed black swan event comes, but not for those that are prepared. And we are keeping a close eye on DR Horton. It is still trending down, but still probably 12 to 18 months away from hitting its trough, at which point that will be a leading indicator for the overall stock markets at a top prior to the coming end of cycle. I hope that helps to give you clarity to show you how we are tracking on the 18-year land cycle so you can be prepared for the times ahead. It will be turbulent times, so be sure to be on the right side of it for when the market turns. You can always email me or Alex if you're looking to get into the property market, if you're looking to build out your portfolio, or if you're unsure what you should do with your existing portfolio. Shoot us an email. Happy to jump on a call, discuss where you're at, and see if we can work together. As always, this is by no means financial advice. This is just general content in nature. This is my thoughts, my processes. This is my story. Be sure to reach out to professional advisors to get advice before making any acquisition. Until next time, thanks for watching.